In this video, I'm going to talk about whether you should buy now or wait for the crash, how the UK could be in the deepest recession of the first world and leading economies, and answer some of your questions like whether you should sell your stocks and go to cash right now. Firstly, I'm going to talk about the portfolio and how we've performed compared to that of the market this week. And disclaimer, I'm not a financial advisor, so if you seek financial advice, please see a licensed professional. The Organisation for Economic Coordination and Development has suggested that the UK is the worst hit in terms of GDP retractions than that of the leading economies. They've stated that we would see a decrease in 11.5%, which is higher than that of most of the other countries, which is the worst they have listed and predicted, such as the US, which is around 6 to 7%, and just ahead of France, which is minus 11.4%. And I think this is due to the fact that the UK relies heavily on tourism, manufacturing and construction. Most of these sectors have been hit very hard, and it does mean that our economy is certainly going to do worse than that of others because, whilst yes, we have a mixed economy, it's quite overexposed to these sectors. And despite such bad news, we've actually seen somewhat of a rally on Friday. When this news was released, people or investor sentiment was somewhat higher, although this was probably to be expected, as typically after 3 days of consecutive losses, such as Tuesday, Wednesday and Thursday, which we had seen a considerable decrease in the market, you are likely, there's an 80% chance, statistically, I read this online, it may not be true and I may be just chatting random fake statistics. As they say, 99% of all statistics are made up. Supposedly 80% chance that the fourth day will end in the green, and today it did. It ended with the FTSE 100 being 0.5% up. However, in my portfolio that was not the case, and I think this is just due to the influx of retail investors, and in fact there's people that refer to them as the Robin Hood generation, and I suppose I fall into this as well because I'm a younger retail investor that has started buying individual equities quite recently. But what they're doing is they're currently still buying into the market for whatever reasons they may have, and that's what's causing it to slightly rise, even though we've had some terrible news. Personally, I don't think this will hold up for much longer, and I do think in the next week we may see the June 2020 crash. But then again, who am I to think that I can predict the market, right? It's unlikely. But what I do think is that whilst the stock market is not the economy, I think the stock market, rather than being logical and following that of the economy, it's decided to look at the future. And I think investors, as a common mindset, we all believe that the economy will recover, even if it is painfully slow. And that's why the stocks had rallied over the week before last. We started the week at a value of 6,500 and the portfolio is still sitting at that amount. Yet we've lost so much. Why is that? Well, I have deposited £525 into my portfolio this week as part of averaging down as we drop further. And I've invested pretty much all of that. This is because I wanted to get more into certain stocks, which I'll talk about later. But we have gone from being up in the green by £1,000 to now up in the green by £400. As I said, I don't care too much about market appreciation of my stocks. And in fact, I'm genuinely happier that it's decreased because it means I can buy into these stocks at a lower price and average down on my investments. And actually, since March, we have seen the largest market sell-off, and I think this trend will continue. Stop losses are going to be hit and the market's going to fall further. And this week, my portfolio has performed quite poorly versus that of the market. Whilst the market has dropped about 5.5%, the portfolio has dropped around 7.5 to 8%. It's meant to have a slightly lower beta volatility according to Simply Wall Street. However, this could be changed due to the new stocks that I've bought, and perhaps I'm slightly above it, but I'd still need to have a beta volatility of 1.3 or above to do that. So I think this week we have underperformed the market. And if you look at my activity for the week, I've been pretty busy. I've been averaging into red row, opening 2 new positions, and these companies are, firstly, Ashtead Group. I mentioned this in my FTSE 100 growth stock to buy in June 2020. So if you'd like to see that, click the card at the top right of the video. I needed exposure to the industrial sector. I think this is a company that leases construction equipment to other companies. And I think this is a great business model to have, and it is more than likely going to survive this pandemic crisis. And that's why I've added them to my portfolio. It's a very small position at the moment, but I plan to average in. And if I see this drop, I'm going to keep buying more and more in. And eventually this will become one of my strongest holdings in my portfolio. Not as high as Red Row, but certainly in the top 5. I've also opened another position with Games Workshop. Honestly, this is probably my most favourite, and this stock I utterly love at the moment. No, I'm not a big fan of the Warhammer collection. Yes, I do have the Total War Warhammer game, and yeah, it's quite incredible. I'm not like a die-hard fanboy of this sort of product, yet I really love the business model they have. And this is something I will talk about in future, but they have really changed things up in the last few years, and that's why they've seen significant share price appreciation. And certainly, if this stock continues to drop, even though on Friday it rallied 10%, if it drops, I'm going to be investing a significant amount of my portfolio into the stock. And because it is such a great business, it's consumer discretionary, which I needed more of, and it's pretty much in a monopoly, you can understand why I'm buying this. And this is my favorite stock so far, and make sure to click the subscribe button and click the notification bell, because I will be explaining about this stock on Monday. So stay tuned. Thank you. And this is because I'm extremely bullish on this stock. I think it will do very well in the future, and it also balances my portfolio. As a younger investor, you're not meant to really be dividend investing, but I really like the way dividends work and how that you get money returned to you as a shareholder. So what my plan is to balance between capital growth and dividend investing. I'm still going to be a dividend growth investor, but I'm going to allocate some of my portfolio to that of higher capital appreciation stocks that I can use to benefit myself in the short to medium term, so I can reinvest more into dividend stocks. But both of these stocks I've bought do have dividends. They just have a lower dividend yield of around 1.5% each. However, Games Workshop have been growing it at quite a strong rate. And so if that continues, then it still will be a great dividend growth stock to own. Once again, the top performer has been Rio Tinto, and honestly, I'm guessing this is due to the rise in iron ore prices over the last week, but they've consistently seemed to do that and outperform that of the market. Whilst yes, in the last few weeks they have kind of just held their value more than anything, it is still impressive to see that they had gained 3% in the time that the market had a large sell-off. The same with Games Workshop. Yes, I've only owned this stock for a week, but on Friday they had gained 10%. Double-digit rise on a day that the FTSE 250 had only gained less than a percentage point. However, I am a bit disappointed in some of my other stocks in my portfolio. Two typically defensive stocks, such as SGE, Sage, and DGE, Diageo, they typically are meant to hold their capital value better than that of these aggressive stocks, and that's not what's happened. In fact, they've seen significant decreases of around 5 to 6% each, and for a defensive stock, that's not good. That's dropped pretty much as far as the market has. This could be just because I bought at a higher average share price, and that's the reason for seeing this, but it does alarm me. But it does present a buying opportunity, and if I wanted to, I could average into these more defensive stocks. However, I'm calibrating my risk tolerance, and I want to get more riskier stocks and go full aggressive if we do have another downturn. In recent news, the government are still not delaying Brexit. They've got till the end of July to delay the Brexit negotiations, otherwise we have to leave at the end of this year. And quite frankly, I think it's a very bold but strong move, and I'm still very bullish on Brexit. I think this is extremely clever from our government, and whilst the EU and all major economies are suffering from the pandemic outbreak, we are using this as leverage to negotiate better terms and therefore really pressure the EU to accepting a less favourable deal for them so they can reduce the weakness in their gross domestic product of their economy. I do hope that they don't delay it and that we get straight to this, because I really think this is an opportunity here. Now, to the main part of the video. Should you buy stocks now or wait for the market crash? I mentioned last week that it really depends on your overall net worth and how much you have invested in the stock market. If most of your assets are invested in the stock market, then you should start to build a cash position. And if you're not invested in the stock market, then you should start building those positions now. But I also think you should take advantage of this correction. If most of your assets are in the market, you should at least cost average into this, because we may see a small correction and then a considerable rally. This might be the last buying opportunity for a long time. And if the market continues to go down, well, you can consistently cost average further into the market and get better value on your shares. And whilst the market downturns, I've decided that personally, I will start depositing certain amounts of money each day that we are consecutively downturning. Whilst I may not reinvest it on that day, I know that I'm going to be investing a significant amount if this is a market crash, and I want to be ready for it. However, I do think it's a very wise idea to start setting targets now. Look at what your wish list is and your watch list. Pick companies that you really like the business model of and set a target to buy them at so that you can get them at a considerable discount. I'm going to tell you these stocks that I've got at a discount, such as Redrow. I'm looking to build further into this position. Currently I have around 315 shares. I would like 400 or perhaps 500 shares. And I'd like to get this at an average price of around £4.40. If the stock drops below that, I'm going to start depositing significant sums and buying up that stock. I'm also going to be buying more of Ashted Group, AHT. I want to develop this position further, and as I said, want it to be one of the highest positions in my portfolio. I would just like this to drop below 20, and I'm just going to consistently average bit by bit into it. However, the one I've got the biggest target on is Games Workshop, like I spoke about earlier. And if this stock drops below £60, I am going to be putting a considerable amount of my net worth into that stock. And if it drops further than that, such as less than £45, then I'm putting pretty much all in. And this is because it would be at such a great value that I'd be a fool not to take this opportunity. And those are my targets, goals, and what I'm waiting for. It's best to keep a few stocks in mind, because if you're trying to keep track of 10 to 20 different holdings, it can be quite overwhelming. So pick the stocks you like the most, set price targets for them, and wait. If we don't reach that amount, then oh well, you've built a cash position on the side, you've maybe averaged a little bit into these positions, but at least then you have invested some amount, and therefore in the future you will benefit from it. I think it's important to remember to stay invested, keep cost averaging, and set those target stocks to your wish list. And with these goals in mind, I believe that I personally and you and we as investors should benefit in the long term. So now it's time to answer some of your questions. I've got a few questions today. In future, I'm going to find a better way for you to contact me, but if you'd like to ask a question, please leave a comment down below. So firstly, Robbie asks, I'm 15, just got Freetrade, and I put £20 into it. Which stock should I buy to earn money in the short or long term? And the first thing I'd like to mention about that is that I think it's great that you've thought about investing at such a young age. The fact that you're 15 and you own Freetrade is quite incredible. And if I'd have known that earlier, I certainly would be significantly further on my path to my goals. However, it is very unlikely that you're going to see much of a gain on that initial investment. £20 is not a lot in the stock market, and you'd have to see significant returns on investment get some money back. You might earn a few pence over the course of a year, and you'd have to see a return of around 50% just to make £10 on that money. However, I do think it is important to buy a company you like or an index fund. You do that now so that you can get used to the overall volatility of the market, especially during this pandemic crisis, because this may be the most volatility we'll see for a while. Learn how to stomach it. See that you may have lost half of your investment, but stay invested, because that is an important lesson to learn now. But it is also important to start thinking about increasing your income. I understand you're 15 years old and that you're likely still at school, and that your working path or your career path isn't going to be happening for a few years. But once you are on that career path, you should look to increasing your income, as you will benefit a lot more from doing that than investing. You should invest at the same time, but you should look to increase your income over those first crucial years as much as possible, so that you can invest more and therefore compound your investments more and more. I've also got a comment from James here that I'd like to answer as it relates to the topic of the video, and he says, great vid Osborne, I'm in a very similar boat where I've seen the holdings I have rally this last week. So obviously this was 6 days ago, back when the market and the last week had rallied a considerable amount, and then obviously this week has happened. And it felt really great until, like you say, you can't really average in as nicely anymore. Feel like I'm back at a crossroads. Do I sell everything whilst it is a high and reinvest back in when they drop? Do I look for more undervalued companies and add them to my portfolio? Or do I sit on cash and see if my existing stocks drop and then average in more in the future? Thank you, James, for the comment. And so firstly, I think it is okay to take profits. If you think some of your stocks are overvalued or trading at higher than you think they should be, then it is okay to sell some of your stocks. However, as a long-term investor, you typically want to buy and hold. It depends what your goals are in the future, really. But yes, it is fair if you wanted to sell out of some of your stocks and then reinvest that money in the future. But do take it in mind that these stocks could suddenly rally again and you're going to miss out on that opportunity because you decided to hold cash. But you should definitely try not to time the market, as time in the market is better than timing the market. And if you'd have sold out thinking, right, I want to stop losing money. So in the peak of the pandemic crisis, if you just sold out whilst we were at the bottom of the market, which would have been terrible timing, you would have lost something like 47% of your investments. You just sold out and then you would have missed out on the return of 38% from that initial bottom. And so how can you really know if the market will drop or if it will rise? And so it's good to just stay invested in these periods. If you sell out at the bottom and then the stocks keep rising and rising and rising, you're suddenly going to have in your mind, well, this can't be true. Why are the stocks rising? And you're going to keep doubting this until it reaches a certain point where you think, well, I guess I'll have to buy back in. And at this point, it's already gained 20%. And then you're at a higher risk because what if that point you've bought in then drops again? You're going to end up losing more money. I do think you are correct, however, in having some cash. And I do think you should build that cash position now, as times are uncertain and high volatility could lead to discounts, and having cash on the sidelines does mean that you can buy in. But do not sell all of your stocks, as you're likely going to miss out on the bonuses of staying invested in the long term. And you will be rewarded for staying invested in times of uncertainty like this. A lot of people had seen it if they'd bought in at February, and at least last week they were in the green. From the peak in February to last week, from the whole of this pandemic crisis, they were actually in the green. And so there is a reward to staying invested. So make sure you don't sell all your stocks. If some of them are overvalued, then feel free. I think it's fair to say that you should liquidate some of your assets, but make sure you're ready so that if there is a downturn that you can buy in. And it does feel bad to average into your stocks as they are rallying further, but you need to think, where do I think this stock will be in terms of value in the next 5 years, 10 years? If I think this stock is going to be worth 2-3 times as much in the next 10 years, then now is probably a great time to buy. And in the future, you're going to be looking back thinking, I really should have bought more of this stock at this price because I really missed out on a long-term gain here. And so thank you for your question. In the next portfolio update, I'm going to talk about tracking dividend income and creating a spreadsheet for the future. Thank you for watching. I'm Osborne Foreman. Have a good afternoon.